Welcome to Taking Stock for the week ending the 9th of December 2022. I'm Kien Trinh, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share market. Welcome, Jason. I can't believe it's the end of the year and Christmas. Hopefully it's usually a seasonally positive period for markets.
Yeah, that's right, Ken. I'm actually hoping that Santa Claus can help us sustain this market rally beyond and even into the new year as well. So fingers crossed for that, Ken.
Yeah, fingers crossed indeed. But before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so any charts and tables presented today shouldn't be relied upon as a guide for future performance. Well, Jace, another interest rate rise this week with the RBA increasing the cash rate by 25 basis points. That's now interest rates are at 3.1%, the highest level since 2012. And Governor Lowy, he continued to stress that inflation in Australia is too high and expects interest rates to rise further next year.
Yeah, it's an interesting point, Ken. Markets are now anticipating for the cash rate to peak out at 3.6% next year. The chart on screen shows the current interest rate expectations, which is in blue, compared to expectations or forecasts in September, which are in orange. As you can observe, the interest rate expectations have trended lower on hopes that inflation rates are close to peak and that this will help support the market rally over the next 2 months.
Yeah, of course, we do understand that high interest rates can weigh on the stock market because it reduces the present value of future cash flows and also lead to higher corporate debt costs as well. But even though the full impact of the latest interest rate rise has yet to be felt, economic growth has begun to slow, with Australia's GDP rising by only 0.6% in the September quarter, Jace.
Interesting as well, Kien. Real-time indicators such as the PMI or Purchasing Managers Index for the month of November also paints a very similar picture in that manufacturing activity has trended lower on slowing sales and also new orders. So while the inversion of the 10 and 2-year bond yield suggests a growing risk of a recession next year, it is important for investors to remain calm. Remember, an investor's ability to compound wealth over the long term is typically associated with time in the markets and not timing the market. So for example, the market rally since late September caught many investors by surprise, especially for those that took up defensive positions only to miss out on the sharp gains.
Yeah, I mean, wise words, Jace, but also we do understand as well that equity markets, there is a lot of uncertainty around the equity market performance during recessions. And this can be seen with the chart on screen, which looks at the performance of stocks 12 months before, during, and also 12 months after a recession. Interestingly, the average return leading into and during historical recessions have been fairly flat, with the share market generating positive returns about 45% of the time. But according to this chart, what is more important though, and it's important for investors, is to prepare for opportunities a recession can generate. In the 12 months following historical recessions, you can see that the market has averaged a return of 16%, and it's been positive in 91% of cases.
Yeah, it is an interesting chart, Ken. Investors should also not fear a potential economic downturn because the outcome for the share market is extremely difficult to predict. So instead, you should focus on what you can control, and that is ensuring that your portfolios are exposed to companies that can withstand the challenges presented in a slowing economic climate. Invest in companies with superior financial health, strong cash flows, and also manageable balance sheets.
Yeah, and historically, these companies have been able to withstand recessions quite well, but we've seen the risks have certainly increased with corporate insolvencies having been on the rise. And just this week, one of Australia's oldest engineering and construction companies, Clough, they went into administration with losses of around 103 million. That's due to rising rates and soaring material and labour costs as well. And this has created contagion fears across the sector, especially given that Clough has 7 projects underway in Australia, one of which is the Waitsia project, which is due to start production next year. and also help Stargrowth stock Beach Energy gain a foothold into the LNG market for the first time. But stay tuned for more on this later in the episode.
And also within this sector as well, Kien, we also observed a massive share price collapse of Downer EDI, which is an engineering and construction contractor in marginal financial health. The company released a profit downgrade, and it appears that management may have overstated their earnings by $30 to $40 million over the past 4 financial years. This means that its marginal financial health could actually be worse than what we originally thought. We believe the company represents a potential value trap, and that the share price volatility simply reinforces the importance of diversifying your portfolio across quality, financially healthy companies within the market environment.
Yeah, margin pressures are certainly lingering there, Jace. But moving on to some stock highlights this week, retailer of strong brands, including Smiggle and Peter Alexander, and Stargrowth stock and Star Income stock, Premier Investments, they released their first quarter trading update, which was above market expectations.
Yeah, that's right, Kien. Sales were primarily driven by a buoyant Black Friday sales period, and this helped improve in-store foot traffic as well as attract many customers into the online store as well. More importantly, management noted that their inventory level is well positioned for the critical Christmas and also back to school trading periods in January and also February next year. The announcement should lead to positive earnings revisions for the stock.
And of course, also we would expect the earnings upgrade to assist with their free cash flow generation and sustained dividend payments, with the stock currently on a forward gross dividend yield of about 5.8%. And they are expected to go ex-dividend in January 2023. Also, these retailers, they continue to defy expectations despite the threat of rising interest rates. But moving now from retail to a more defensive sector, earlier this week, NBN Co, they announced a revised pricing proposal for wholesale connection charges, with price hikes expected across internet plans with download speeds of between 50 to 100 megabytes per second. And these changes could come into effect by 1st of July next year. So, Jace, how would this change impact Star Income stock Telstra?
Yeah, it is a really interesting series of events. From what we understand, 74% of Telstra's customer base have internet speeds between 50 to 100 megabits per second. However, Telstra's plans are generally more premium than its peers, and they charge around $100 per month. So if the increase to the NBN is around $2 to $3 and they make a margin of around, say, $50 per month, then the overall impact is probably around 5% and is not that material. So the overall impact on group margins is even more immaterial because the contribution of the fixed line segment, including the NBN Internet division, represents only 0.7% of total earnings. As such, the proposed NBN changes does not alter our opinion of the company's dividend forecasts, and the stock currently trades on an attractive yield of around 6%. And moving on to the corporate calendar next week, a number of our top 4 banks are set to present their AGMs.
In Under the Microscope this week, we take a closer look at how the collapse of one of Australia's oldest engineering and construction firms, Plough, has delayed the future profitability of Stargrowth stock Beach Energy, leading to its sharp share price decline over the week.
That's right, Kien. Beach Energy is a mid-cost producer and owns a diverse portfolio of oil and gas assets across Australia and New Zealand. It also has a 50-50% joint venture with Mitsui in the Waitsia gas field located in the Perth Basin. Waitsia is ranked as one of the largest gas fields ever discovered onshore in Australia, and the project was expected to deliver Beach Energy its first gas output in the second half of calendar year 2023.
Yeah, sounds like a massive project there. And the collapse of contractor Plough means that the project will be delayed, with production in financial year 24 estimated to be about 15 to 20% lower. But investors need to be aware that earnings changes from the lower than expected production numbers can be offset by rising oil and gas prices.
And also with the recent share price decline, the stock is trading at a discount to consensus share price target. While this could represent an opportunity for some investors, you'll need to be mindful that forecast earnings may not have fully accounted for the lower production in FY24. Even though the stock is well covered by 15 consensus analysts, valuation on resource stocks are highly uncertain due to the difficulty in predicting future commodity prices.
And for those who are not comfortable with the active risks associated with Beach Energy, they can refer to our peer comparison table and look for alternatives within the oil and gas sector, such as borderline star growth stock and star income stock, Woodside Energy, or even borderline star growth stock, Santos. So, with GDP data and leading indicators all suggesting an economic downturn is on the cards, a useful question for income investors this week is how can you identify stocks with sustainable dividend yields, especially if we're going through hard times? Now, currently, there are a vast number of companies paying attractive dividend yields, but to differentiate between a quality income play and a yield trap, there are a few key metrics you should really look at. Firstly, focus on financial health, because having a strong balance sheet, especially across those liquid assets like the cash balance to total liabilities and quick assets to current liabilities, that ensures that the company has sufficient short-term capital. The next thing also to remember is that the dividends are paid out in cash, so pay attention to cash flows rather than reported earnings.
For industrial and resource companies, look at the margin between free cash flow and dividends. Free cash flow is operating cash flow less capital investments used to fund growth. Without a margin, you'll need to dig a bit deeper and further to understand why and whether the company has enough cash on the balance sheet to sustain the dividend.
And for REITs and utilities and also infrastructure stocks, it's better to use operating cash flow here because the capital intensity of these businesses means that there will be high investments, maintenance and expenses, which can often lead to negative free cash flow here. So best to use operating cash flows for those sectors.
For the financial sector, we have to resort to earnings instead of cash flow because cash flows do not represent cash from operations, but also from customer accounts such as deposits and loans. These tend to be liabilities and should not be included in the analysis of whether the dividend is sustainable.
Yeah, that makes perfect sense, Jason. And aside from cash flows, other factors you need to assess, including the trend in the payout ratio, for instance, earnings revisions, and whether the dividend yield has been artificially inflated by a quick share price decline. So the great thing about Stock Doctor is that you can easily look at the history of dividend payments, the track record, to help you assess the risk to future dividends. Well, Jace, that's all we have time for today. Thanks again for your contributions.
Pleasure was all mine, Kien.
And a reminder that we do have a fantastic Christmas offer on at the moment. It's a gift that keeps on giving. If you find our content and support valuable, please feel free to refer us to your family and friends so we can help them invest successfully as well. And more details can be found on our website at www.lincolnindicators.com.au. And of course, there will also be 2 more Lincoln Live sessions for the year. So if you have any pressing questions, please come along and our team of experts, including Tim Lincoln, will be there to answer all your questions on stocks, the market, and investment strategy. So to summarize, remember, do not let fear of a possible recession impact your investment objective. Timing the market is difficult, so it's best to concentrate on what you can control, and that is the risk management of your portfolio, being diversified across those financially healthy businesses. And history has shown that recessions represent excellent opportunities for investors, especially with markets historically rallying 91% of the time following economic downturns. Take care and have a happy, healthy, and prosperous week ahead.